We had the 9-bar bull micro channel from here to here, and the odds were there were probably buyers below, and the bulls would get a second leg up. And that's what happened today. There were buyers below, and the bulls ended up getting trend resumption. But there might be more traders selling above the July 3rd high. And therefore, that makes me think we may end up going mostly sideways here. We're far from the moving average, and that increases the chances that we're probably going to get a pullback fairly soon. And therefore, I expect we're probably going to be mostly in a trading range, which makes sense why we're getting profit taking up here. Today, we formed an opening reversal and then basically a bull trend that ended up forming a small pullback trend here and a little bit here. And we formed a trading range. We had a lot of this sell-off here. There's a few things. One, the selling pressure. This rally was late in a channel on higher time frames. And then the selling pressure here increased the risk that whatever rally we would get that we got was going to eventually come back to this price level. First bar of the day, we had a tight bull channel going into yesterday. And the bears ended up forming a bear bar with bar 1. And it's a strong enough bar that we may go a little bit lower, but better to wait and see what the price action looks like over the first 2 to 3 bars. Follow through on 2, good for the bears, probably going to go a little bit lower. And then 3, we formed a bull reversal bar. Bears, they'll see it as 2 legs down, and the bulls will see it as 2 legs down, and they want the reversal up. But after a 4-bar micro channel, probably sellers above 4 and sideways to down. 5 outside down, 4 outside down, good for the bears, may go a little bit lower. And then 6 doji, follow through selling, but it looks like a bear leg and will become a trading range. Not a great sell. And then 6, another doji, probably downside becoming limited. And then 7, we have a bear bar. We've already had dojis 5 and 6. And that increases the chances that 7 will get another, at 7 or 8, that 8, we may get a reversal up. So there might be more traders buying down here than selling. 8, reversal up, good for the bulls. Probably going to get a couple of legs sideways to up. Okay for bears to get out and bulls to look to buy. 9 consecutive bull bars, 8 and 9, probably going at least a little bit higher. And then 10 buy climax bar, bigger than 8 and 9, good for the bulls. Increases the chances that we may end up pulling back, especially since we're in a trading range. Big sell-off, big rally, big confusion, may go sideways. 11, bear bar closing on its low. Good for the bears, but following 3 consecutive bull bars, I suspect buyers somewhere below 11, but they may not come in until we get back to the 8 high or the 7 close. 12, doji, decent sell-off and reversal, probably going to go because of the rally and the micro channel up to 10. I expect we're probably going to test back to the 10 close and maybe the 10 high. And then 12 and 13, strong enough reversal with the 12 low and the 13 and bar 13 rally that will probably get at least a second leg up, and we may end up trying to break above the 61 high. Yesterday formed in, and so we may end up trying to break above 61 and possibly get above the high of bar 5. 3 consecutive bull bars, 12, 13, and 14, so probably going higher. And then 15, another good bar for the bulls, probably by the close. Doji, 16, not a good sell, and therefore probably buyers below. And then we have follow through on 17, and then 18, a bear bar. For the bears, not a good sell. Too many. The market's been going sideways to up, and therefore, if anything, there's probably more traders buying below 18 than selling it. 19, bull bar, good for the bulls, but forming part of a channel. But the channel's too tight for traders to be selling. And then 20, we have a bull doji, but the doji's at the top of the channel, and therefore maybe more profit taking than buying up here. But there's probably buyers near the bottom third of the 19 bull bar. So 20, even though 20 may lead to profit taking, it's really not all that great of a sell. 21, You can see we found buyers in the bottom third of 19, the most recent bull bar, so probably going to continue to go sideways to up. And then 22, we have a bull breakout above 21, but it's a wedge, 17, 20, and then 22, and that increases the risk that we start to go sideways soon. And then 23, doji, but a bull bar, because the channel up is tight, we still may end up going a little bit higher. 24, bull breakout of the bull channel, good for the bulls, probably profit taking fairly soon. Then we have a doji on 25. It's a possible fail breakout of the bull channel, but if you sell below 25, you're selling in the midpoint of this bull channel already, and therefore it's selling a little bit too low in the range. Whenever you get a tight bull channel, it makes it really difficult for traders to be selling, and that's because the odds are there's probably buyers below. 26, bull bar, probably going to continue to go higher. And then 27, another bull bar, but we're starting to get a lot of overlap, and that increases the chances of profit taking soon. But because of the channel up being as tight as it is, the reality is even if we get the reversal down, there's probably buyers around the moving average. 28, bear bar, probably buyers below. And then 29, a doji, consecutive bear bars. I suspect we're probably going at least a little bit lower. 30, we have a bull bar, but a doji. Not a great buy above, but because we're so far from the moving because the channel up is tight, even if we pull back, there's probably buyers not far below. But it's a weak high one buy after consecutive buy climaxes, probably more sellers above than buyers. 31, outside down, good for the bears, may go a little bit lower. And 32, bear bar closing on its low, reasonable for the bears to get out, reasonable for bulls to get out, even though the odds are whatever reversal down we get is probably going to be minor. And 33, consecutive bear bars, 32, 33, probably more traders buying down here than selling, and therefore that makes me think the odds are will probably go. That makes me think that the odds are there's probably more buyers down here, especially with it being the first touch of the moving average in a lot of bars, and with how tight the channel is. The bears need to do more than just get a bear bar at the moving average. 34, bull bar, doji, probably going to go mostly sideways here. And then 35 consecutive bull bars. We're probably forming a trading range at this point. And therefore, I expect we're probably going to go above the 31 high, and we're probably going to go above the 28 high later today. 35, 36 consecutive bull bars, good for the bulls. But following the sell-off, 32 and 33, big down, big up, we may form a tight trading range here. And then 37, we have a breakout pullback sell. The bears will see a lower high for the bears and a possible major trend reversal, but not enough bars down to 34 and not enough bars up to 37 to call it a major trend reversal, and therefore probably buyers below 37. And I suspect the downside is probably limited. 38, bull bar. 38, a bull bar, good for the bulls, probably going at least a little bit higher, probably going to get a second leg up after 34, 35, 36, 37. And then 39, 2 legs up for the bulls, good for the bulls, but probably more traders selling up here than buying. And then 40, bear bar, closing on its low. Part of the reason there's more traders selling up here than buying is 37 is a bear bar closing on its low in a tight trading range. And therefore, typically, when you have that happen, there's often sellers above the bar, and therefore I thought the bears who sold the low of 37 and sold more above 37 would probably be disappointed on the trade and look to get out break even. 41, bull bar, closing on its high. Probably going to go at least a little bit higher. And then 42, bear bar, good for the bears. I suspect the downside is limited, and if anything, we're probably going to get the upside breakout, at least for a bar or two. Bull breakout of the triangle, 43, good for the bulls, may go a little bit higher. And then we have a pause, 44, and that's a sign that the bulls, or something is not quite right for the bulls. 45, second leg up for the bulls. Not a great second leg for the bulls, but the channel up is getting tight, and it's making it difficult for bears to sell below bars, and that increases the chances that there's more buyers below. 46, another high one buy, but because the channel is so tight and bears aren't making money below bars, it makes me think we're probably going to go at least a little bit higher. 47, Another bull bar in the rally, good for the bulls. And then 48, a bear bar. But again, too many bars up in the rally. That any bear bar you get is probably going to lead to sideways trading at best. And then we have a bull bar 49, a little bit bigger than the bars to the left, so climactic, starting to get consecutive biclimaxes, and that increases the chances of profit taking soon. But then we got another doji on the bar on the bar. Oh, then we got a bear reversal bar on bar 50. 50, a warning that we may start to pull back soon, but I think the bears need more climactic buying than just 49. 49's climactic, but it's not significantly more climactic than the bars to the left. And that makes me think that the odds are we may go a little bit higher. 51, doji, not ideal. And then you can see 52, we formed a bear bar, micro double top for the bears, 50 and 51, but then not a good entry bar, 52, channel's too tight. So it looks like more minor. And then finally, we got something big on 53. 53, strong enough surprise, makes me think the odds are we're probably going to pull back for a couple of bars and probably test back to the high of bar 52 at a minimum. So if anything, there's probably sellers up here. 54, bear bar, but enough of a surprise 53 that we may need at least a small second leg. And then 55, doji, bears not getting the follow through they need, but a bad high 155, so probably sellers above. And then 56, a bull bar, but not a great buy above. And therefore, you can see we ended up going sideways in a tight trading range. The bulls tried to get the upside breakout, but again, getting late in the rally and getting fairly climactic away from the moving average, probably going to pull back soon. And then we got a bear bar on 59, and the bulls got selling on 60, and they got more selling 61. And now we're starting to get to the moving average. 3 consecutive bear bars, good for the bears. Bears may look to sell a pullback, but as far as selling closes, it's too much at support for most traders to be willing to sell closes right here. And then we got a doji on 62. That's a warning that we may pull back. 63 outside down, good for the bears, but I'd rather look to sell pullback at this point. I don't want to sell right at the moving average. 64, 65, trying to get a bear break out of the moving average, but doji's 63, 64, and then 65 bear bar closing at or above the midpoint. Not really enough selling pressure for traders to be selling right here. And then doji 66 probably going to pull back, and then 67 bull. It's an entry bar, but it failed to close above the 66 high, so a sign of weakness. And then 68 another bull bar, but tail 67, tail below 68 increases the chances of sellers somewhere above. And then 69 a doji, not a great sell for the bears, buyers below. So the first reversal down is probably going to be minor. And then we got another bull bar on 70, and you can see went outside down 71. So the market rallied, pulled back, rallied again, sold off. And this might be the start of the bears getting a second leg down, but not all that clear. And then 72, double bottom 66, but tail above 72 and below 72, so we may pull back. And then we got a bull bar 73, and you can see what happened. The bulls, they tried to rally above 73, and more bulls started scalping out. And so instead of traders desperately buying above 73 for a rally up to the high of the day, more traders started selling up here. Part of the reason they sold was 74 is a weak entry bar for the bears, and the bears used that weak entry bar for selling. And that's what led to the reversal down 75. 76, good bar for the bears, probably going at least a little bit lower. And then we got the big bear bar 77, and we tested back to the apex of this triangle right here, and pretty much just went sideways. For stop entries, I thought the first reasonable stop entry of the day was probably buying above 8. And then bears, do they sell below 11? I would not. I think it's okay for bulls to get out below 11, but the reality is it's minor, which means their chances are bulls are probably going to look to buy again. And then bulls, they can buy above 13, they can buy above 14, they can buy above 15, any of these bars. Odds are any reversal down is probably going to be minor at this point. And then bears, I think bulls, maybe they get out below 28, certainly below 32, but I don't think they have to. And then bears, they can sell 32, but it's probably minor at best, which means really not ideal. And then since it's a minor reversal, bulls will be more aggressive or willing to buy any reversal attempt. So some bulls buy above 35, others buy above maybe 38, or they wait for the breakout of the triangle and they buy above 43 or 46, the breakout pullback buy. And the bulls, if they buy 46, where do they get out? Some get out below 50. I don't think they have to. You'll have some bears sell below 50, but it's low probability. And then when they see the disappointment 51, they'll look to buy again after bar 50. Actually, I said something. I made a mistake there. What I meant to say was some bears will sell below 50, but when they see 51, they'll be disappointed and buy back their shorts. And the bulls know that, which means the bulls will be pretty quick to buy when they see the 52 rally. And then bulls that are long, I think they get out either below 54, definitely below 59, 60. And then bears that can sell, and some get out above 66. I think it's smart too. And then I think it's really tough in here. Do you get out above 66 and sell again below 71, and then buy again above 73, and then sell again below 75? Yeah, but what do you do with everything in between? It's really easy. It looks easy in hindsight to trade with stop orders in a tight trading range. You think, oh yeah, of course I'd buy here, then I'd sell here, then I'd buy here, then I'd sell here. But the reality is, in real time, it's not always that simple. And so most traders better off using caution. Limit orders. I thought lots of limit orders. I thought buyers probably a 5 and below 6, meaning there's probably buyers some distance below 1. In other words, it's a trading range. And therefore, if you're selling a stop below 1, there's probably a lot of profit taking near 1 times the range of that bar. And same with any of these other bars. Outside down bar here, probably buyers some distance beyond. And then I thought limit orders, buyers below 17, buyers below 20. I thought buyers below 22, sellers above 30. I thought buyers below 37, and buyers below 45. I thought buyers below 51, but really tough trade. And then I thought, maybe sellers up here, but fairly tough. And then buyers at the moving average, scaling and lower for a bounce. And then that's really pretty much it. There's other trades as well. I think those are the easiest ones. And then buy the close, sell the close. I think it's probably buy the close. Probably 14, better 15. And all through here, it's not buy the close of a bull bar, it's buy the pullback. So when you see a close of a bull bar, don't buy the close, set a limit order and buy a pullback. And then same thing through here, 36, don't buy the close, buy the pullback. And really all the way up, it was better to buy pullbacks than buy closes. Where do I think we're going tomorrow? I think tomorrow is probably going to pull back. We rallied. We had a deep trend line break, and we're testing the highs. We went above the 9-bar bull micro channel, which was the minimum expectation. And now we're probably evolving into a tight trading range. So I suspect there's probably, but you can already see there's already decent profit taking on today's bar. So we may end up just forming a tight trading range in here. But I think the bears need to do more than what they've done right here. They need to do more than simply get a retest. They need selling tomorrow, and they need follow through selling. You need some sign of urgency to convince traders that it's a reasonable sell up here. Let me take a look at a few questions. Good question. When you scale in with double the original contracts entered versus scaling in with an equal number of original contracts entered. I think he said, would you scale in with double the original contracts? Okay, so what's your opinion on scaling it? So doubling the position. So you buy 1 contract and you scale in, and on your scale in you buy 2, versus you buy 1 contract and you scale in, you buy another contract, another 1 contract. I think it varies on the goal. I think the reality is, that's scaling in against a trade is really, really difficult. And the reason is you have to really understand what that calibrated expectation is behind the trade. It's a fancy word for saying you really have to understand what the trade should be doing, and you have to understand when it's failing. And so if you think about it, if you understand that, let's say you have a bar, and I'm trying to find an easy example. Let's say you have, I think here's a good example, 54. You look at 54 and you think to yourself, okay, 54, it's consecutive buy climaxes late in a trend. The odds are probably high that if we go above the 54 high, there's probably sellers. So some traders will sell below 54, and they might double their position above the high of the bar. And that's reasonable. There's nothing wrong with doing that. But the difference is you really have to understand that the odds are this is a logical topping pattern. A mistake would be to sell below a bar like 11 and then double your position above the high of 11. And that's the problem that a lot of traders would get into when it comes to scaling in. They'll scale in on a stop order that is really not a scale-inable stop order. It's a stop order that's not worth scaling in. Bar, what I mean by that is not all stop entries are created equal. When you have a bar like 11, 11 is a possible reversal of a bull breakout, and therefore it's reasonable to sell below 11. It's reasonable to sell below 11 betting on a failed breakout and maybe a double top and a sell-off down to the lows. But the reality is this has a much greater failure rate, which means there's much greater risk that this is just a pullback from the start of a bull rally. And if this is a pullback, if 11 is a pullback from the start of the bull rally on 10, that means that we can go all the way, way up here. We can get some sort of measured move of the low of 8 to the high of 11 or high of 10 and go all the way up here. And therefore, selling below 11 and scaling in is really, really dangerous. It's the same thing with selling below 32 and scaling in higher. It's dangerous because this might be a breakout on a higher time frame, which means we could reset this trading range forming here, might get an upside breakout. However, up here, selling below 54 and scaling in higher is less dangerous because the odds are this whole thing is becoming a bear leg in a trading range, which means there's greater risk that we're going to reverse down and test back to this area or at a minimum, we're going to reverse below 54 and at least get a couple of legs down. So this is much more likely than price going below 54 and up a lot higher. That's the hard part with scaling in. You have to understand what the expectation behind the trade is. I think most traders, when they're starting out, should not scale in. But if they are going to scale in, I'd rather scale in with one contract and then scale in another contract. The best way to scale in is with stop orders. So sell one contract below 54, and if you're going to scale in, wait for another stop order. But again, selling below 59 is right next to your entry price 54. Probably not worth doing. When you're scaling in, it's really better to spread out your entries. Otherwise, you'll have too much risk. One of the benefits of scaling in is you lower your average cost. So if you sell here and you scale in way up here, your average cost is going to be somewhere over here. But if you sell here and then you sell more here, your average cost goes from here to maybe here. And therefore, that's not that much of a difference. And that's one of the mistakes that traders make all the time. They'll scale in, they'll sell strong momentum and scale in with strong momentum rather than selling and then waiting for the momentum to pause and then sell. Of course, the reality is this is not good to be selling anyway. Therefore, if you are selling, it's better just to be flat. It's better if I'm selling above a 12 and then I see a big bull bar 13, I'm really just better off cutting the loss on the trade and moving on to the next trade. Okay, someone asked, why does Ali say that scalping is better for beginners than swing trading? Well, I kind of see it both ways. So Al, there's an argument that people ask. Al says beginners should only swing trade, and Ali says beginners should focus on scalping and breakouts and second legs. Let me get a sip of water, and I'll answer my thoughts. I think you have to take what each person is saying and really think about it. What Al is saying is most traders starting out should only swing trade, which means they should go for twice the risk, because if they can go for twice the risk, they don't have to have as high of a win rate to be profitable. What Ali is saying is traders should learn how to trade breakouts. And therefore, the requirement of skill level is different for each trader. The swing trader doesn't have to have the same skill set that the scalper trading breakouts and second legs has to have. But here's the issue, is that one of the problems, the way I look at it is this. I think you need to understand always in if you're going to swing trade, which means you really need to understand the market cycle. You need to understand what's a trend, what's a trading range, what's a channel, and be able to recognize the market cycle. And then the next thing is you really have to understand, if you really think about it like that, if you can understand those pieces and read it on a chart, you're already kind of halfway there as far as understanding breakouts and second legs. And therefore, to also be a really good swing trader, you also need to recognize the importance of a breakout and the strength of a breakout. That's the whole point Ali's making, is when you see this right here, even if you're swing trading, you have to recognize that 32 and 33 is not a strong breakout for the bears, but you have to recognize that 14, 15, and 16 is a strong breakout for the bulls, and therefore it's high probability. And so my argument, I see this argument comment often, like at least occasionally, and my thought process is you really have to understand both of them. Of course, you can just take the Walmart trade. I'm going to buy above 8, put a stop below 8, and hold for the rest of the day. But that's assuming you don't sell below 1 and hold for the rest of the day, or you don't sell. If you buy above 8, do you sell again below 11? And then, there's so many other trades you can mess up on. So I don't think it's as simple as beginners should only focus on swing trading. I don't think it's all that simple. I think there's a lot of buts in that statement that Al is making. One of the buts is beginners should only focus on swing trading. What Al's really saying is beginners should focus on going for more than 1 times the risk. However, you still have to understand the basic forces of the market. You've got to understand the market cycle. You've got to understand, volatility expansion, volatility contraction. You have to understand that the market breaks out and then forms trading ranges, then breaks out again. There's a bunch of things you have to understand in between. So I hope that answers your question. Okay, here's a good question. I've been trading for 1 year and studying every day, 3 to 4 hours a day. And what I'm struggling with is my emotions, and it kills my trades. Obviously, I still have lots of things to learn, but those emotions really get to me. I will be up on the day, and for some reason I still trade, just to trade and kill my gains. Any advice on how long it takes to overcome all of this and get a grip on this stuff? Yeah, it's different for everybody. One of the things I would say is I think that most traders are going to be better off kind of trying to think about trading as a factory. And the reality is you don't need to be a high performance trader on day one. What you need to be is consistent. And therefore, the easiest way to be consistent is a factory. You build yourself a set of rules and understand exactly what you're trading and why you're trading it. Even if that means you're going to get 1 trade a day, really build a system out of that trade and force yourself to follow it. You can do it. There's all sorts of things in the Brooks trading course you can build out of that. Second entry, you could do, the easiest one is a 3-bar micro channel. That's one of my favorites. And I often talk about that one. 3 strong big bull bars, buy the close or buy the pullback, second leg up, 3 strong bull bars, you get a second leg. And if you could just learn to only take, for one, force yourself to only take those trades and make that your goal. Everything else is irrelevant. You measure the performance based on how well you executed the plan in front of you, because that is really what matters at the end of the day. And I think the problem is, when you're trading, you've got to be the person building the financial design. You've got to be basically think about all the hats you wear as a trader. You're the CEO, you're the trading floor, you're the risk management, you're the compliance department, you're all these different departments. And the problem is when you're trading, you have the business owner mind saying, I've got to make money. And you've also got the trader hat on saying, I need to follow these trading rules. And one of the worst things that traders do, I often think about, Elon Musk is a good example. Regardless of politics and how you feel about him, he's a very smart person. And obviously he's created a lot of intelligent, pretty big companies. And I often think of something like Tesla. Tesla's factories, I would imagine, are very driven with, everything's done based on logic. Decisions are made based on logic. And, you could use, if you don't want to use Elon, use someone like Jeff Bezos, Amazon. And the way I think about it is, when you're trading, your job is to be the factory worker. Your job is to simply take whatever you've been given, your standard operating procedures, your SOPs, whatever you've been given, that's your job. That's your trading. And it's supposed to be boring, and that's all you do. And outside of trading, you take off the factory worker hat and you put on your Elon hat or your Jeff Bezos hat, and you think about strategic. What are you, here's the financial goals you're trying to get to. So if you want to make 100% in a year of a return, that's not the trader's job to figure out. That's the financial person's job to figure out of the company. And they work backwards. They say, okay, here's 100% in a year. Here's how many trading days we're going to have in a month. So I need to make, let's say let's just say you're going to trade 10 months out of the year and you need to make 10% a month. Okay. Then you walk backwards from that. I want to make 10% a month. How many trading days am I willing to trade? Just for simplistic sake, since I don't have a calculator in front of me. But if you're going to trade 10 days out of the month, then you need to make 1% a day. And if you're going to trade 20 days out of the month, you need to make 0.5% every day. One of the reasons why emotions get in the way of trading is that people really don't understand the financial design of what it is that they're trying to do. They don't have an end goal. They know they want to make money from trading. They know that they have this destination that they want to reach, but they really don't have it quantified. And if you can actually quantify what it is that you're trying to do, it actually becomes a lot easier. Like, one of the, I always kind of joke about it, but it's really true. People forget, if you can make, I often say this, if you can learn to make, I forget the numbers, but let's say you could let's say you could start with $5,000 and learn to make $50 every day and do that every day consistently. And then you could have $10,000 in an account. And then if you had $10,000 in an account, what if you could learn to make $100 every day consistently? So 1%. If you could do that for enough period of time, that 1%, $10,000 might turn into 20. But if you do that for a couple of years, you're going to have a decent sized trading account. And that's really what you have to focus on. Now, the reality is, the fallacy that you often see is, people think that, you can make, the fallacy behind all that is there's several of them. One is you'd have to keep making 1% every single day, which means you'd have to optimize your risk to meet whatever the capital is in your account. The other issue is psychologically, it gets harder and harder to risk that same amount as an account gets bigger. That's the way I think about it. Emotions are typically driven based on two things. They're driven from the thought of you're going to fail and not make it. So you have this goal, you don't want to fail. And then the other thought is, what if my trading plan's wrong? So if you really understand exactly what you're doing and you leave nothing to chance, you can quantify, you've back tested it, and you can truly prove, you know what the performance numbers are and you know what they look like, and you know when your performance, basically what you have to know is you have to be able to take your live trading data and prove based on your studied or your back tested data that what you're doing is in line. That's really the only way you can know if you're trading in a way that's going to work. And what I mean by that is there's obviously other ways you can do it, but the point is, if you want to feel less emotional with your trading, what you have to do is you have to have a back-tested metric. It's kind of like a factory. I saw something about Amazon warehouses. I'm not really a big fan of Amazon, but I saw a documentary about how their factory, or some of the Amazon, I guess, distribution workers, what they call them, the people packing all the boxes, they've actually got metrics on what the average packing time based on the size of a certain item is. And therefore, they have, quotas for every minute, like how many boxes somebody should pack, or every hour, how many boxes somebody should pack. And therefore, they instantly know if someone, they can know just by the data if someone is actually slacking or if they're performing their job at an optimized level. And that's how you should think about your trading. If you have all the numbers back tested, then you know whether or not your forward testing, which means your live trading, is in line with the back tested data. And as long as it's in line with the back tested data, then you're going to be in the right spot. Now, obviously, a high performance discretionary trader is going to outbeat, the factory worker every time. But the factory worker can do really, really good, can do a really good work. And so if you want to limit your emotions, work on becoming the factory worker when you're trading. The factory worker's job is not to make sure the trading plan is profitable. The factory worker's job is to simply sit there, be quiet, and pull the lever every time they're supposed to. That's the easiest way to think about your trading. And what that means is 99% of the work is done outside of the trading day. And that 1% of the work is done real time. I hope that answers your question. Or at least I hope that's helpful and gives you something to think about. Yeah. Trading everything you see is not always a good thing. I have many tools. So question, I have many tools to gauge the volatility cycle. What do you use to gauge volatility? Mine is just the moving average. You can measure what price is doing based on the slope. So when the moving average is climbing, when all the bars are above the moving average, it's a bull trend. And when price is getting far away from the moving average, like so, that tells me that it's getting climactic. The strongest trends you can have if we can find something here. Here's a good example. This just continued rally, and it's in line and parallel with the moving average. The moving average is flat and rising, and price is rising in near parallel to the moving average. That's a sign of really, really strong buying. That's how I think about it. And then when you have price action that overlaps the moving average back and forth, I know we're in a trading range, and I'm a lot more cautious about holding on to trades. Someone said 99% of the work is done outside of the trading hour. So for every hour we traded live, we should spend 99 hours studying. And sort of, not really. You're missing the point of what I'm saying. The point is, when I made that comment, what I'm saying is think about it like a football game, or pick your favorite sport. I'll use football. Football players, NFL players, I don't know how many games they play, 15 games, 14 games in a year, something like that. And therefore, there's 14 games over the course of a year, and there's however many other, and so they spend all their time practicing for those 14 games. And so if you think about it, if you tally up all the hours they spend working for their football, probably less than 5% is going to actually be less than 5% of their work is going to be spent or less in the actual game itself. And then that 95% is going to be actually done watching film, lifting weights, keeping their body healthy, all those things. And so the way I think about your trading is 95% of the work is outside of the trading day. In other words, you're thinking, you're mental rehearsing, you're thinking through your plan, you're thinking through all the strategies that you're basically running. You're taking care of yourself, you're taking care of your health, making sure you're getting well rested. All of those things are outside of the trading day. That's kind of one of the things I want to talk about in Orlando is, it's something called the OODA loop, which plenty of you, I'm sure you've heard about, but basically building flowcharts and really kind of thinking systematically about your thoughts. Really having the cycle of thoughts that are the same each time when you're looking at a bar. But anyways, I hope that's helpful. All right, so we'll see what tomorrow, but probably more sideways trading. All right, hope everyone has a good rest